Okay. All right. Good evening. Good evening, audience, ladies and gentlemen. Before we start, I am doing some sound testing first. So, can you hear me? Let's see some response from the live. Hi, good evening, everyone. Testing. Sound test. Can you hear me, everyone? All right. Okay. Good evening, everyone. Can you hear me? Sound test. Hi. Hello. Testing 1. Testing 2. Testing 3. Yeah, maybe some delay. I wait for the respondent to reply. Okay. Okay. Hi. Okay. Okay. I got the response already. Okay. Hopefully go smooth, everything. Okay. Let's start our sessions today. Okay. Good evening, everyone, and welcome to our webinar sessions. I'm Suling, and I will be your host today. So before we continue, as usual, some heads up. Okay, the content we provide today is purely for educational purpose. There's no buying or selling advice, so please understand the risk involved before you involve in the futures trading, and you may seek the independent financial advisor for investment decisions before you start to invest in the futures trading. Okay, so before we introduce our speaker, right? Yeah, I got some good news to all of the participants, and we are excited to announce that our trading derivative trading challenge is back, and this time with brand new additions, Apex Derivative Trading Challenge 2.0, which is brought to you by Apex Security Berhad in collaborations with USA Malaysia, and this challenge continue with the same game and same rules, and we are inviting all of you to take part once again. Before you get started, do visit our official website challenge.apexetrade.com and make sure you read the terms and conditions. This will give you a clear pictures of the rules and how the trading challenge work. Okay, and also if you'd like to know more about our derivative trading challenge or updates from the Apex, don't forget to like and subscribe our official YouTube and Facebook page. Stay tuned for market insight, updates, and more helpful guides. All right, everyone. Now let's get to the highlights of today's sessions. Okay, we are really excited to have Mr. David Ng again with us. Okay, David is a full-time proprietary trader with Iceberg X Sendirian Berhad, where he focuses on trading commodity and indices, especially our very own Malaysia index and crude palm oil futures and some others foreign contract. So some of you might already recognize him from his market coaching sessions, seminar, or his article in the Star, Business Time, and The Age. With the years of trading and research experience, he helped many traders kickstart their trading journeys and sharpen their strategy. So today, David will sharing some things really practical. Okay, with the title "Stop the Bleed, Win the War: Can Spread Trading Minimize Your Outright Losses?" In other words, we also say how spread trading can be another way for you to manage the risk, reduce the stress in trading, and give traders more option than just outright position. So without further ado, let's give a warm welcome to Mr. David Ng. Okay, drink some water first,
Yeah,
brother.
yeah, sure, yeah.
Okay,
Okay,
all right.
thank you, Suling,
I pass
for
to
the very
you.
kind introduction.
Yes.
So just before I start, just allow me to share my slides.
Okay, sure.
Uh, just let me know if you can see my slides on full screen.
Yes.
Okay,
Yes, I can see the slide.
okay, yeah. Thank you very much.
Just
Yeah. Thank you for joining tonight's session. And I think this as what Suling just mentioned, the title, stop the bleed and win the war. If you are new to spread trading, I know, spread may seems like, it's a strategy, it's a trading strategy that looks complicated, but it's far from the truth. In fact, I think if you know how to apply spread trading as part of your trading arsenal, just not only outright trading, I think it can hopefully it can in a way minimize your losses, because outright is very directional in one direction, we call it. Because if you just do outright, technically you have a view whether the market's going to go up or the market's going to go down. If you are spread, technically you're taking two different opposite positions. That means you can be longing one contract and you're shorting another contract. So the complication comes when you're dealing with the difference instead of dealing with the outright price itself. So that's where a lot of people mistaken that spread trading is highly complicated, is a very complex strategy, and it's only reserved for professional traders. Now it's far from the truth. In fact, nowadays I think the more people get understanding on how to actually do spread, especially with regards to calendar spread as a type of trading strategy, you can see there's more participation in the market, and then you can mix that with also obviously with outright trading as well. So in a way it enhance your hopefully enhance your profitability, or in another way is also try to minimize your losses, because outright itself it carries a lot of risk. The movement of outright contracts usually are very volatile. So spread later on when we touch in a later part of the webinar, hopefully you can gain an understanding why a lot of people favor spread compared to outright trading. So let's just start. I think I just want to also highlight and re-emphasize the point again. So any materials presented here today is purely for educational purpose. So I just like to take this opportunity to thank Apex Securities for inviting me over to speak on today's topic. And hopefully at the end of this session, if you are new to spread trading, you probably can kickstart your journey to spread trading. Now, if you are already doing spread trading, hopefully I can give you some insights on how to actually view the market. And I think any opinion that's expressed by me is purely my own personal opinion. It's not reflecting any opinion, whether it's from Apex or whether it's from the exchange itself. So, do take it as more of an educational purpose. And any material presented here is hopefully can enhance your understanding on spread trading concept itself. Now, this is the agenda. I think importantly, it's important to get the concepts right. So I just want to introduce to you the concept of spread trading. There is many advantages. Obviously, there's also certain disadvantage of doing spread, but I think advantages outweigh the disadvantage of doing spread. So again, I think a lot of people are, I won't say fearful, but I would say they try to avoid doing spread because they don't understand the principal mechanics of it. But once you grasp the basic understanding of it, I think it's actually very simple. So ultimately, what you need to understand is that when you're doing spread contracts, you are ultimately looking at the price differential between two different contracts. That's all it is. And what's your view on it? So there's also a saying, which I also want to debunk the myth, that a lot of people say that you can't apply technical strategy on spread trading. It's only on outright. No, I think it's far from the truth. Later I'll share with you certain strategies that you can use whenever you look at trading spreads. There's many ways to look at it, and I think importantly, whether you're doing outright spread or any other various strategy, is always at the end of the day a method for you to stay long in the market, to survive long in the market. It's all about managing risk. So I think it's important that we must have a way to manage our risk, which regardless of whatever strategy we deploy. So it's important that we must have a proper risk management in place in order for us to see the kind of profitability, or even in fact to survive the volatility of the market. So just to give you a very basic understanding of spread. So basically, spread involves a simultaneous buy and sell. So if you there's many types of spreads. I think what what our focus into this spread webinar is going to focus on calendar spread. So calendar spread is a very popular type of spread that is traded on Bursa, especially on the CPO calendar spread. So it's basically ultimately trading the price differential between 1 month and another. Usually it's a further month. So right now you could be trading a spread which is November contract against a December contract. So you're looking at a price differential between these two different months. So the act of doing spread is basically a simultaneous purchase or selling in a particular month with a reverse action on the other month. So that's all it is. And what you matter most is always a price differential. It's not about a price itself for one contract, it's a price differential between two different contracts. So I'll share with you what I mean by that. So spread itself is a very relative value. That means you only care about the price differential. We don't really look at where the outright direction is or where the outright is moving towards. We are more concerned is about the price differential between two different contracts. Now, because the act of doing buying and another opposite position, in other words, you are actually hedging your position. So compared to outright, you either buy or sell. So that means you're exposed 100% to the effect of the market. But once you do a simultaneous opposition buying and selling, technically your risk has been reduced. So a lot of people are interested to do spread because the margin requirements are actually much cheaper. And as a risk management strategy, you are actually exposed to lower risk as compared to doing outright, which you are exposed to the full magnitude where the market is moving. So like I mentioned, I think there's a lot of different types of spreads. I think there's three major ones. First thing is always we call it time spread or calendar spread, which is very common. So if you're trading the Bursa Malaysia, we always refer the spread as a calendar spread. So for example, let's say if you have a view on November, December, because November, December are currently the active contract. So you have a view of the price differential between November contract and December contract simultaneously. So you are just looking at the spread between these contracts. You can obviously pair, for example, November with, let's say, January next year. You can also look at the price difference. We can also do November and February next year. You can pair with so many other months. But keep in mind, as you go further into forward months, first thing first is that the volume definitely will be thin. There'll be less traded contracts as we go further away towards the future. So that means that the price differential could be very wide. It could be down to because there's not much volume on those 5-month contracts. So importantly, when you choose a particular calendar spread to trade, always look at the volume or the active contracts per se. So right now, if the active contract is December, so we look at all the December calendar spread. So December 2025, January 2026, it could be a very good active high volume calendar spread to look at. Now, so just keep in mind, if you're doing further months away when volume is very thin at those 5-month contracts, do keep in mind, the spread can be very wide. And that's where, if you are not careful, the volume can be very thin. Sometimes the spread can just tear and it's usually against you. So always be mindful that, choose the calendar spread months which has a higher volume relatively compared to other calendar spread contracts. Now, also we have intermarket. This is another type of spread, which means that you're not looking in terms of time spread. You're looking, for example, like a commodity that's related. So for CPO, next commodity related is F-soil. So intermarket, we can do a spread between, same contract month but different product, FCPO and F-soil. So there's always a price differential after you have calculated whatever the so-called theoretical value of the particular product, whether it's F-soil, FCPO, it should be this price, and there's a spread according to that view. So you trade on that basis. So that's what we call intermarket. So this is very common. If you look at CPO, you can also look at SOI, which is very one product that's actually relatively very closely related. Soybean oil is definitely one product to look at, especially when trading palm oil. But keep in mind, the dynamics of CPO and the dynamics of bean oil is quite different. In a sense, when I say dynamics, it could be whatever factors that affect CPO, could be news, could be fundamental factors, not necessarily is going to have the same impact for the bean oil market. So that's where a lot of people will find it very difficult to trade the spread because, supposingly, if let's say, supply is tight in CPO, you should see higher CPO prices. And if let's say supply is abundant in bean oil, you should see lower prices for bean oil. But, sometimes it doesn't work that way because, in SCPO and bean oil, it has its own different fundamental dynamics that affects individual respective markets. So that's where you need to be very careful if you're doing intermarket spread. Now, the last bit, inter-exchange spread, this is basically looking at different exchanges. So certain exchange will have a similar contract. So for example, let's say if you're looking at soybean oil, we have our local Malaysia soy. Again, also we have the Thailand Commodity Exchange. We also have a similar soybean contract. So obviously there's arbitrage you can look at. There's obviously arbitrage trading opportunities that's present in those markets. But I think that mainly there's a spread, because usually either it's a factor of currency, or it's a factor of the size, the specification of the contract could be very different. That's why it commands a spread between both markets. So as a trader, sometimes you also look at inter-exchange spread to see whether there's opportunity present. So, but I think most popular is always usually the time spread, or what we call the calendar spread, which is more commonly traded among the traders. Now, essential of spread trading is actually very simple. So if you have a view that, for example, if you're looking at calendar spread, for example, you're looking at December 2025 and January 2026 calendar spread CPO. If you have a view that December prices is going to go much higher compared to January, technically you're bullish on this spread. For example, let's say if the price difference between December and January contract now is a positive 10 points, which means December price is higher than January by 10 points. And you are expecting that this spread is going to go wider. So what you will do is that you will long December and short January. So you're technically you're longing this particular calendar spread. Why is that so? Perhaps maybe because you foresee that December is going to be a short month. Festivities are there. So production is going to be low, prices are going to be strong. So December prices should move faster compared to January. So in this example, when you have that view, is you go to the calendar spread market, December, January calendar spread, and you long a particular spread, hoping that the price differential between December and January will get wider over time. Now, vice versa, if I reverse that scenario, if I say that December, we expect production to be weak, but turn out production to be good. So prices in December is not going to be doing well, because high production normally you expect prices come down. But January is a different story, because January normally it's a shorter month, and January people markets generally have more optimistic towards the January. So prices tend to do better in January. So when you have that kind of view, when you are bearish in December and you're bullish in January, technically what you're doing is that you're selling a particular spread. So I think the mechanics of it depends on how you view the market and how you see the spread will behave or evolve according to time. Now, there's many factors that accompany this. Some people look at fundamentals to determine whether this spread can go wide or can narrow, or some may just look at chart, purely on chart, and see, okay, looks like technical reading is telling that this particular spread is going to narrow or this particular spread is going to widen. So there's many ways to look at it, but I think fundamentally the equation is very simple. You're just looking or you're trading the price differential between two different contract months, and it depends on how you view the spread is going to behave for these two particular periods. So this is how it works. So I'm just showing you an example. This is on the QST platform. So you can see a November contract. This is the outright, then the December outright contract as well. So if you just look at, you just take the differential, 4358 minus 31, 4358 minus 4389, which is currently last traded on these two respective contracts. Theoretically, the spread should be doing at minus 31. Why is it minus? It's because the first month of November is trading at a much lower price compared to December. So the spread is negative. Now, if November is trading much higher price, say for example 4,004, and December is 4,389, then the spread is positive 31. So it's importantly the negative and positive plays a big role. So in this example, when you take the price differential of these two particular outright contracts, you get what we call a spread differential of 31. So this is what is currently bidding and offered on the calendar spread contract. Now keep in mind, the Bursa Malaysia CPO calendar spread are exchange traded. So that means it's not a synthetic thing. It's actually traded by the market. So sometimes you notice that when you take the differential between November and December, how come you take the difference only 30, but we are trading at minus 31, 32. It does happen, but those instances are very short-lived, because that means there's arbitrage opportunity involved. So that's usually what happens. So keep in mind, I think calendar spreads in Bursa Malaysia is actually exchange traded. So that means people can actually bid and ask on the spread itself. So this is a ladder on the calendar spread for November and December. Okay, so here are some benefits of spread trading. I think first thing is this, like I mentioned, outright you have view. There's only one view, up or down. When it comes to spread, you care is about difference. So whether the spread will go wider or narrow, that's the view it is. Because of that, if you're doing outright, you are pretty much 100% exposed. If expect market goes up, market comes down against you, you lose money. Now in spread, because you're holding simultaneous position, and the most important thing, the volatility of a spread prices are way lower compared to outright. For example, if outright today move 100 points, you don't expect spread to move 100 points. Normally, it's between the region of 10 to 20 points for those active contracts. Sometimes it could be lower than that. So first thing first, the margin required is very low. Second thing is that the volatility of the spread is actually much lower. So other than that, I think a lot of if you understand the fundamental factors that affect palm oil, because palm oil prices are very seasonal. Later I'll show it to you what I mean by seasonal. So when it comes to seasonality, the spread contract sometimes does display certain seasonal tendencies, and that's where a lot of people tend to exploit those opportunities. But again, it's sometimes seasonal factors don't actually play out. So that's where you really need to be careful as well. Now, because of the lower margin required, a lot of people tend to do more size. It's size ups. They don't just do one lot. Probably because of the margin required is very low. Probably they do 5 lots or in excess of 10 lots or whatever it is. So in a sense that low margin required, technically your rate of return is usually higher. Now, last bit of doing spread is that sometimes if you're holding a view on outright, for example, and because futures contracts has expiry, and if you want to roll this position or roll a view towards the future months, you can actually use a spread to roll over your position. You don't have to manually close that particular contract month and open another one in forward contract months. You don't necessarily need to do that. You can actually use spread to roll your positions over. Now, again, that's also very dangerous because you are holding a view that the futures market is highly volatile, especially you got CPO. So if you have a very long term view, you need to tend to be right, because in markets sometimes gyrate from very big range, and trend can be quite short-lived. So these are the things that you really need to be careful. But spread is also useful if you want to express a view of the market in a longer term view. You can actually use spread position to roll over your outright positions. So instead of closing it manually, you can actually use a spread calendar to do it for you. Now, just to show you this example of spread margin. So outright margin is about, keep in mind this may not be the latest. So if you want to get the latest margin, just check with Apex, representative. They can give you the latest margin. So then you look at it, I think in essence the margin required for a particular pair is between 1,002 to between 2,000 ringgit per lot, and one pair basis. So as compared to outright, you need 7,000 ringgit. So technically, the margin required is actually much lower. So again, because of the lower margin required, so therefore you need to do sizing. When it comes to looking at positions in your spread trading. Now, just to show you, this is outright contract table for FCPO. So technically, you have almost close to 2 years or even close to 3 years worth of contract listed. Now, as you go further into backward months or forward months, you tend to see sometimes these certain contracts are not even traded because the volume is not there. So as we go further into the forward contracts, you definitely don't see much volume. So always put your emphasis on looking at least the first 6 months forward, and nothing more than 6 months. Once you go above six months, technically you start to see volume start to diminish. So that's where it's critical. You want to choose the calendar spread to trade. You really need to look at volume as well. So these are example of spread contract table. So we have normally what we pair the existing and the next forward month. So we have September and October, which is one pair. Then the next one, October and November. So that's technically one pair. So currently now the active contract is December. So December, January is the calendar spread that you should be looking at, because that is the most active contract, which has the highest volume. So you don't want to be trading a particular contract where you tend to see volume on those calendar spreads are very low, because again I mentioned those if volumes are low, sometimes the spread can be very wide or it can tear. So that you have to really be careful. Okay, I just want to share this table. If you look at it, this particular table, you notice that the near months are trading at much lower prices compared to the forward months. For example, October, November calendar spread, you notice that it's a minus 38 calendar spread point. So that means October prices are trading 38 points lower compared to November. Now, same goes November, December is looking at minus 31. That means November is trading at 31 ringgit lower than December contract. So why is this so? It's just telling you that the front month contracts are trading much lower compared to the middle months or the far months, because generally when you see this thing happen, that means the market tend to be oversupplied. If the reverse is true, if you start to see the near month contracts are positive, which means, for example, October is trading much higher than December, then that is indicating to you that the market is undersupplied. So right now you can see that what the market is, or what the spread market is telling you based on the price differential, is telling you the front month markets are actually oversupplied, because that's why the front month prices are lower compared to the middle and the far month. Now this thing can change, the spread can change. Like for example, if dynamics of the fundamentals start changing, then you notice that the spread would actually from negative, it can actually turn to positive. So you have to be very careful. So when you start to see shift in fundamental shift in market sentiment, can really move the spread market from a negative to a positive, or even vice versa, positive to negative. So important to really understand the dynamics of what affects a particular spread market factors. Now, these are some of the common spread trading myths. Hopefully I can just help to address. First thing is that some people say spread trading is highly complex, so therefore it's more volatile. It's far from the truth, because later I share with you why spread trading is considered it's less volatile, and in terms of risk mitigation, it's considered very good because you are exposed to much lesser risk. Now, it's not easy to understand that is true. If you are new, obviously you need some time. Just by judging from this session, going through it may not be sufficient. You need to actually work out some examples, and try it on your own on a simulated account, and try to understand how the mechanics of it work. But once you get the whole principle and concept of this, it's actually going to be very simple. So spread trading is actually not complex, but once you get it, it's actually very simple. Now, applying technical analysis, people say you can't do that because it's only applicable to outright trading. It's far from the truth. Later I'll share with you what are the certain tools you can use using technical analysis tools to apply on spread trading. Now, fundamental does not reflect any age. Again, this is far from the truth. So I mentioned earlier, you look at the spread table in the earlier slides. Why is the near month contracts trading lower? Normally, it's just telling you that the near months are oversupplied, therefore price has to be low. But if near month is undersupplied or there's lack of production, you don't see negative spread. Most of the time you see positive spread. So fundamentals does reflect certain behaviors in the spread. So in a way, if you want to understand more of the spread mechanics or spread dynamics, you also need to understand a bit of the fundamentals and seasonal factors as well. Now, it has low volume. Some say, spread outright trades in the region of 30,000 or 40,000 contracts per day. Do we see that in spread? We don't see the kind of volume, but I would say that, those active calendar spreads, easily you're looking at about 3,000 to 4,000 lots per day. So I think that's very liquid. Now, as I said, if you go forward along the curve, you go further into other months, you start to see volume starts to come down. So that's why choosing the calendar spread is also very important. Now, just to tell you why spread has lower volatility. So what we have here is that the chart on the left is technically your outright contract. This is basically the November CPO outright contract. So you notice this bottom panel here is ATR, which measures the range of the market. Is trading about 76 points. That means the daily range of the November contract is about 76 points. Now, the chart on the right is showing you the November-December spread contract, calendar spread. And notice that the ATR is only about 7 points. So that is telling you the range of a day is about 7 points only. So compared 70 and 7 points, it's very big difference. So now if you are wrong, you are exposing the risk of 70 points. If you are wrong in spread, you're exposing yourself to a 6 to 7 points risk. So that's a whole different concept of volatility in spread trading. So you can see that when you do spread trading, the volatility is much lesser compared to doing outright. Now, so like I said, volume is people always say volume is very limited. Now, as the contract gets closer to expiry, normally volume will start to decrease. But when the contract becomes an active contract, usually it's the third month in the CPO market, it's usually will record high volume. So like for example, this November, December, per day I think it went to as high as even 15,000 lots traded. So that's huge. So it shows there's volatility in the market, there's volume in the market. So there's no reason to say that, oh, because of low volume, you shouldn't participate in the spread market. So it's far from the truth. Now, if you look at the active contract, the spread volume is actually quite massive. Now, if you look at it, if you look at spread chart and compare to outright chart, you notice that outright chart sometimes, morning session the market goes up, afternoon session it will come down, something like that. Now, in spread contract, generally you tend to see more trend happening because you're talking about price differential. You're not looking at one particular specific contract. You're looking at two different contracts altogether. So when you start to see trend forming, like it breaks below moving averages, it's coming down, or the spread is going to be more negative. That's where you start to see there's more trend happening in the spread market. So generally I've been doing this for quite some time. Normally, I do notice that when it comes to spread trading, there's actually more trend formation as compared to outright, where outright sometimes you see trends, sometimes you become a non-trend market. So that's where if you are looking at trends in a particular charting strategy, spread could be one good way or one good place to look at it in the beginning. Now, so if you look at it, this is basically plotting. What I did here is plotting all the different contract months right until August next year, 2026, and you plot their daily price. What you notice is what we call as a curve here. The curve is like this. You start to see that as we go into December, January next year, prices are getting higher. But once past March, you start to see prices start to come down. So this is what we call the forward curve dynamics in the CPO market. So what is telling us basically from this curve is that the near-month contracts is trading lower. It's for the simple fact that fundamentals are still quite bearish in the sense that there's still supply is meeting demand. There's sufficient supply. In fact, there's too much supply until that people are willing to pay lower prices. But now, if this curve can and does change, when you start to notice near month starts to go higher or starts to trade higher compared to the further months, normally that indicates to you that the market is very tight. And this usually happens towards when you come to low production period, especially in the fourth quarter, or even you have weather extremities like monsoon, or flood situation. It can change the curve dynamics. So understanding this can probably help you to see how you want to structure your calendar spread trades. For example, if let's say you notice that the front months are actually getting weaker compared to the further months, technically you can short a front month contract and buy a further month contract. So that's how you use the forward curve or the curve dynamics, as we call it, to actually form your judgment on your calendar spread. Now, again, if you plot like each month consecutively and the calendar spread consecutively, and you plot their prices, again you can see a very similar pattern. You can see that near month contracts or near month calendar spread contracts are trading negatively. So it goes back to the picture before this, which means that the near month contracts are quite bearish, but the middle and far month is actually quite bullish. That's why the spread is actually negative. Now, as we go into January, February, March next year, you can start to see the spread itself goes from negative to positive. Now, so this is understanding this kind of mechanics will help you structure how you're going to trade your calendar spread accordingly. Now, again, these are all seasonal patterns. Sometimes it follows, sometimes it doesn't follow. It could be one event that can change the whole dynamics or one announcement. So it's important that we have this understanding, we apply it, but we have to also be attentive to certain things that can really change the whole market dynamics of it. Okay, so going back into certain fundamental cues. So if you look at it, this is production pattern for Malaysia over the past, I would say over the past 20 years. So you can see it very clearly that around after August, September, especially during the end of October, you start to see production starts to come down. Now this is a general seasonal pattern. So when it comes to prices, production coming down, stocks levels coming down, you should expect prices to go up because there's tight production. And if you notice around March, April onwards, that's where production tends to pick up. So this bolded red line is this year. So you can see that generally so far production is following the similar pattern to last year, whereby I think production will tend to peak when we go into October calendar period, which is probably by this month, this middle of this month or end of this month. And moving forward into November and December, we should see production starts to come down. So I think that's critically important. So if you are doing spread, you should be careful thinking to short a spread because you're moving into a season where production is actually going to be weaker. which is positive for prices. Now, stock levels are also very similar pattern as we approach towards October, November, especially towards the year end, we start to see stocks levels coming down. So stocks are inverse to prices. So if you have low stocks, you should see strong prices or high prices. If you have high stock levels, you should see low prices. So right now, although stocks are climbing up, but we expect that if production starts to ease, the stock levels should also start to ease, and that will be a support for CPU prices moving forward. So now stock levels, people always say, what's the benchmark we should look at? People always say it's a 2 million mark. Anything that's above 2 million is considered market is a bit oversupply. 3 million obviously is way oversupply. Anything below 2 million is considered undersupply. So right now you're just a tad above 2 million. Whether you can sustain above that, that's still remain a question, because as we move towards the year end, the fourth quarter, normally production is weaker. We should see, stock levels should probably come down below 2 million. If that's the case, I think that's something positive for prices as well. So looking at that, judging from that principle, so if you are bullish on spread, meaning that if you expect December prices to move much faster compared to January, technically this condition is called a bull spread market. So generally what you're doing, you're actually buying a calendar spread into the market. If that's the case, it turn out to be December prices move faster than January, this spread will get wider. Positive to become more positive, or even negative. It can be negative to positive. You could be making that money because you are technically believing that December prices is going to move much faster compared to January. So in this situation, we term it as a bullish spread market or bull spread market. Now the reverse is true. If you believe that the current spread is going to narrow, or currently it's negative, it's going to go more negative because there's more supply coming back and all this. Generally, we are bearish in that scenario. So generally, what you do is that you're going to sell spread. So it's important that in what condition you should be looking at buy and what condition you should be looking at the sell spread market. Now, having said that, some people may just look at chart and from there make a decision. It's also fair enough, which I'm going to share with you later on how we will do that. By understanding all these different mechanics can help you paint a better picture whenever you look at the spread market. Okay, so looking at this, what I have here is that this is November red line. Here is the November outright contract, and this is the November-December calendar spread prices. So you notice that when outright prices tends to come down, you can see spread also tends to come down one direction. So it's quite parallel, but obviously there's certain point or certain instances it doesn't follow, which means that November prices can come down, but the November-December spread can go up. It's an inverse thing. So we can't expect a total positive correlation between the outright movement and the calendar spread movement, but it's a good gauge. So if November prices are coming down, you should expect the November-December spread to go even more negative or start coming down. So that's where you can actually use both this relationship and trade along it. But keep in mind there is always time when it doesn't work. In fact, it goes reverse, and that's where you need to be careful. Okay. Now, having said that, I just also want to put a disclaimer out. I think this happens during 2022. Not to say that spread is so safe that one day movement is only 7 points. Why is there a risk? Now, when markets are in a crisis mode, when I say crisis, if you recall back in 2022, July 2022, that's where the start of the Ukraine-Russia conflict. You can see, sunflower oil was limit up 3 consecutive days. That really caused a panic in the market. So when there's a panic in the market, normally the spread will also panic, and sometimes it could be even more volatile than the outright market. So doesn't mean that safe to say that trading spread, you'll be a certain amount of this range which you expect that kind of volatility. But when there's a proper panic in the market, the spread can actually tear or widen substantially. So that's where you also need to have proper risk management in place whenever you are trading the spread market as well. Okay, now relationship between soybean oil and palm oil. So obviously, if you're trading palm oil, you know these two relationship. Whenever bean oil goes up, palm oil normally also follows. If bean oil comes down, palm oil also does come down. In between both of these two markets, there's a spread. So if you look at this particular spread, so you notice that if you take bean oil price minus palm oil price, intermarket spread, you notice that bean oil tends to be more expensive compared to palm. There's many reasons for it, but it's actually it's quite a natural convention that you expect bean oil prices to trade much higher. Now the average premium between palm oil and bean oil is about 100 to 150 US dollar. There's period where I think it went during the Ukraine crisis, the spread went to as high as 800 US dollar premium to palm, which means palm is way cheaper compared to bean oil. So therefore, it's a natural trade to short the bean oil and buy palm. Now, doing a spread like this, hoping that eventually this kind of extreme movement can go back to its long-term average, it does take time. I think from 800 US dollar to come back down to about 150, almost take them about 2 years. So, in futures market, your expiry, you can't afford to be holding a position such on that long scale. But it's important to take note, one interesting point to take note, whenever bean oil goes into a discount, which means bean oil is cheaper or palm oil is more expensive, normally that discount won't last so fast, won't last so long. So, naturally, if the market is a discount market, I think eventually the discount market will become a premium market quite instantly. So, discount, when it comes to discount market situation, I think there's more opportunity to be seen as compared to looking at premiums, massive premiums like extreme premiums level, because now eventually spread will tend to revert to the mean reversion, but it will definitely take time, and it can take a long time. So that's where important concept you need to take note is that you can't afford to hold a position until eventually the mean or average will revert back to its original level. Okay, now these are some of the fundamental factors affecting palm oil price. So you can't run away. Supply and demand is always key. Stock levels, global growth, ringgit strength is also one important element. Weather is an important place. So if you're doing spread, weather is very dangerous. So if example you have towards the year end, your monsoon period in the east coast, normally that means more weather extremities. That also can create a spread condition whereby those near-month contracts can actually be more positive. So you need to be aware of these kind of scenarios that can play out eventually. Now, government policies can also be a very big game changer. For example, like Indonesia can just decides to implement biodiesel with higher percentage. That'll be bullish for the market. So it all matters on when they're going to implement a timeline. So the spread will move accordingly as well. Vegetable oil movement, these are more related to soybean oil. So I shared to you earlier, the soybean oil and palm oil premium and discount. Discount is actually more favorable. If we start to see soybean oil at a discount to palm, normally there's a good condition to look at the market. Crude oil movement, crude oil and palm oil is relatable because of biodiesel. So you have crude oil blend with palm oil, you have high oil prices, definitely you need more palm oil to blend because it's more incentive. But when crude oil price is low, there's nothing much to shout about because generally that means you have a low incentive to actually do biodiesel. Okay, now this basically mentioned export trend. Again, you can't really see much, but normally around September, October, you can start to see slightly a peak in export trend because India normally restocks or China restocks before year end, before the winter season kicks in. So that usually be a period where they start to buy a bit more. But the rest of it, you can't really see clear pattern as compared to look at production or even stock patterns accordingly. Now, in terms of demand, dynamics for CPO is very clear. China, India is always the biggest buyer for Malaysia. So China right now, you can see the stock levels are actually very high at the port. That means going forward, I don't think they need as much palm oil as they need Malaysia. India is slightly different. You can see that as we get to the Deepavali season, normally they buy a fair bit more. But once that season or that window passes, again, India will also stop buying. So we are also going to be a situation where demand also can be quite big towards the year end or towards the first quarter. So these are some things that we need to watch out as well. Now, crude oil and palm oil, you can see that, I mentioned earlier, high oil prices normally strong for palm oil. Low oil prices is actually not good for palm oil. But it's not a strong factor. It's mainly because the need for biodiesel. So if you have low oil price, actually there's not much need for doing biodiesel. Now, ringgit relationship and CPO, I think recent cases you can see there's not much of a strong influence, but you look at historically speaking, when you have a very big ringgit, normally that's actually positive for CPO prices because that means those importers that using when ringgit gets cheaper, they actually can buy more. But vice versa, when ringgit strengthen a lot, you can actually see CPO prices come down. So the one I highlighted or circle, you can see that whenever ringgits actually weaken a lot, CPO prices actually climb. But when ringgit strengthen a lot, you can see actually CPO prices starts to come down. So Ringgit, although it's not a strong influence, but it does have an influence to a certain extent. So, you can't really discount the ringgit relationship against palm oil. Now, weather-related events I mentioned, this is very extreme. When you have when let's say you face a confirmed extreme events like El Nino or La Nina, generally that means prices will tend to rally. So that's where you need to be careful as well if you're doing spread. So this is basically palm oil price seasonality. You notice from January to December, as we enter into the last quarter of the year, you notice that prices tend to do fairly well, especially towards the November period as well. So November, January period. So we are going into strong period. So you are looking at spread contracts. It's always better to find positions to buy a particular spread because prices are expected to move higher or faster compared to the fundamental contracts. If you do the reverse, if you're thinking to go on a short spread, I think those major periods in terms of calendar periods are those periods that you see prices tend to be weaker. These are again based on seasonal factors. If you look at production tends to pick up after April. That's why May, June, July are usually quite a weak period for the CPO market. Okay, so that's looking at fundamental dynamics and looking at how the forward curve plays a role in looking at spread. Now I just want to move on to looking at technical reading on how you can apply that to spread trading. So like I mentioned, spread tends to trend quite well as compared to outright. So whenever the trend comes down, spread tends to hold that trend for quite a while as compared to outright. The trend can change on a daily basis. So it's very difficult to detect the trend on the outright market as compared to the calendar spread market. So the second choice is always to choose the calendar spread contract to trade. So this one is always goes back to volume. Choose the contract that has the highest volume to trade. So if it's December is the highest contract, so take the December calendar pairs to trade. No point to look at if you want to take a May, June next year, which is not much traded, even for the outright contract itself. So avoid those contracts that actually has lesser traded volume. So you can identify trend using moving averages. So you can apply a 10, 20, 50 EMA period. And you can also use Heiken Ashi, which is a very great tool to look at trends in the market. So if you have attended some of my previous talks, I use Heiken Ashi to determine how a particular trend is forming in the market. So you have moving averages, you have Heiken Ashi, and you plus with the average true range. Technically, you have quite a good setup, a simple setup to trade the spread market. Okay, so just to give you an illustration, so this is basically December January calendar spread. So you can see that once these are Heiken Ashi candles, so you notice there's not much gaps in between the candles, but you notice that when the candles are green and when the body of the candles are very white, it's telling you the market is forming an uptrend market. And notice this, if you plot a 10 and 20 EMA, the red one is 10, the green one is 20, you notice that once the candles are above both the lines, technically this uptrend is forming. So that will be a good opportunity to long this particular spread. Now, vice versa, when you start to see massive red candles like this and it penetrate both the moving averages, it's just telling you that this downtrend is forming. So it's a very clear illustration of using Heiken Ashi to display to you what kind of chart tendencies that you can get based on the trend that's forming in the calendar spread market. Okay, so this is April, May. Just giving you an example. This is April next year, May next year contract calendar spread. So again, you can notice the same pattern. Once Heiken Ashi is green, it's above moving averages. This is telling you that this particular spread uptrend market is quite intact. As long as there's no persistent red line or red candles below both the moving averages, this uptrend is still intact for this April-May calendar spread. Okay, so now which chart is better? So these two are basically a calendar spread for December, January. So if you notice, chart A is basically a normal candlesticks and chart B is your Heiken Ashi. So one good thing about Heiken Ashi is that it shows you quite clearly whether the trend is still continuing or not. So if you're looking at candlesticks, sometimes the moment you start to see a red candle, you panic after a series of green candles, because that you may think that maybe this uptrend is going to be exhausted. But if you are using Heiken Ashi, it keeps you longer in the particular trend as long as the candles are above the moving averages. Trading both the moving averages is just telling you that this uptrend is still quite intact for now. Okay. Now, I'm not going to go too much on introduction on Heiken Ashi. In fact, I think nowadays you can just use ChatGPT. They can give you perfect examples and illustrate to you the history of Heiken and Shi. So this moment. So the main difference is this: Heiken and Shi is more for trend. And Heiken actually is widely used now in terms of trend trading because it's actually only three distinct patterns. You use candlesticks, it's more to mean reversion. It's not looking at trend continuation. It's more of mean reversion. And you look at it, you need to illustrate or you need to identify 100 over patterns, which is actually quite a lot. So it's not easy to really master Japanese candlestick as compared to using Heiken and Shi. So these are the three distinct patterns. As long as the candles are green, it's an uptrend. As long as candles are red, it's a downtrend. So the candles that you need to see is that if it's a green candle with only upper wick, it's a very strong uptrend. Red candle with only lower wick is a strong downtrend. Now, when you have upper and lower wick, you need to be careful. Usually, it tells you that this particular trend is losing strength. Now, obviously, if you start to see like doji or cross type candles, which means the body is very small, almost like no body at all, you have to be careful. That means there's no trend in the market. Market is moving sideways. So if you try to do trend during that time, it's not going to work. Okay, so this is how you should see red candle bar with only lower wick. These are what we call strong red candle bars. The moment you start to see upper and lower wick, that's why you need to be careful. Almost like a doji. It's telling you that this downtrend is almost exhausted. It's going to sideways market. Okay. So look at the size of the candle bar, which is very important, and how it penetrates both the moving averages and the location of the candle. So once you start to see the candles breaking below both the moving average, normally it generally tells you that market tends to move or reverse direction. So that's how normally you can apply using Heiken and Shi plus your moving averages accordingly to form your strategy. Okay. So this example, this is a January-February calendar spread. Notice that this is in the beginning of June this year. This particular spread has not much volume. I think daily volume is almost less than 1,000. But as you get closer to the active or January becomes an active contract, you start to notice volume starts to pick up, and that's where trend starts to form. So you can quite clearly see that when volumes pick up, trends are forming. It form quite nicely. So you can use Heiken and Shi to actually detect trend in the calendar spread market as well. Okay, type of moving averages, simple and exponential. I think most of the examples here I use are mainly exponential because it's actually put more weight on recent prices, so therefore it actually reflect changes in prices much faster compared to if you're using simple moving average. Okay, now there's a couple of things about moving average. So as long as prices are above the moving average, is the uptrend. Prices below the moving average usually is a downtrend market. Now, not only that, moving average is also acting as a support and resistance. So thirdly, also normally we use moving average as a crossover signals. So what we have here is this. So two things here. First thing is that candles are both the moving average. So red one is EMA, the green one is SMA. So you notice the red one is moving faster and enveloping the candles quite closely as compared to green. So therefore, in most examples I tend to use EMA rather than SMA. Okay. Now the application of moving average is actually very simple. As long as the candles are above the moving average, technically it tells you market is on uptrend. Now, you can see that these candles are hugging the red EMA line quite closely until there is a break here. The red candle starts to appear and they break both these candles, is telling you that this red line is acting as a support for this particular uptrend market. The moment when it starts to break, the candle starts to break, that usually be a confirmation that this uptrend starts to turn. So importantly is that you not only have moving average as looking at where the crossovers is, like for example, you have the red one, which is a shorter term crosses above the green one, the longer term. Generally, this is a bullish crossover. So it's not only acting as a crossover signals, but also giving you where the support and resistance are in terms of your moving averages as well. Okay, so this again illustrates the point. You can see that it's holding well above the red line. The moment it starts to break, generally it's a downtrend market. Same goes for here. It tried to break both the moving averages line, it couldn't. In fact, the next candle is a red candle, Heiken and Shi bar, and the body starts to get wider. So generally this is telling you that this spread is going to turn from positive to negative spread. This is basically January and February. So this is just telling you that the moving averages are also acting not only as a crossover signals, but also acting as a support and resistance level. Okay, so how do we apply the active strategy? So the moment you start to see a bearish crossover and the candles are below both the moving averages, and the red Heiken and Shi bar body is actually quite wide. generally that's a good signal to take. So in this example, it's definitely to short this particular spread. So what we have here is that the ATR is 5 points. So how we do that is that if you enter a short spread as -5, the ATR value is 5 points. You're looking at 10 points. Risk to reward is 1 to 2. That means you're looking at 10 points for profit, 5 points as loss. So this is crucial. The level you need to set your target profit is actually at -15, 10 points away from -5. And your stop loss should be at 5 points, or which is at 0. I know the negative and positive can get a bit tricky, but that's how the spread works. So you should be earning 10 points for profit, 5 points for your stop loss. So target profit should be at -15, and your stop loss should be at 0. 5 points above your entry level. So because you start to enter at a negative point. So if you understand math integer, as you go further into the points, 10 points, you should aim your target profit at -15 and your stop loss at 0. Okay. So I think market continue to trend lower. So -15 hit, then I think this is where you should get out. Even though the market continue to go lower, below 15 or even to -20 or what, it's actually not a concern anymore, because your strategy is as such. You are aiming for a 10-point profit based on the strategy that you have evolved. Okay. Now another trading example is looking at October-November calendar spread. This is very clear. You can see formation of red Nikkei bars. The candles are below both the moving average. The ATR is 7 points. So for example, you enter a short entry at -14. So you work on a risk to reward ratio. You're looking at 14 points for profit, and 7 points as a stop loss. So that's working on a negative integer. You should aim your profit at -28 and the stop loss at -7. So it may get confusing because you're working with negative numbers, but the concept is similar. It's the same. So if the ATR is 7 points, you should only look at risk or reward 2 ATR. That means your reward should be 14 points and your stop loss at 7 points. So that's how you work on your risk to reward ratio. Okay, so I think that's pretty much on how you enter and exit. I just want to emphasize this also because a lot of people, as they start their trading journey, a lot of people will just be, I just want to make money and that's it. I lose money, I don't know why. Even when you make money, you also need to understand what you've done well. So it's important that you must have a way to evaluate your performance and record your trading matrix accordingly. So these are some of the key things you can look at: win-loss ratio, volume, equity curve, profit factor, and whatnot. These are some of the key metrics that you should have, at least as a way to gauge your performance. Then obviously some of the weak points and strong points you must take note as well. So work on the weak points, strong points you continue to develop it. And I said whatever I mentioned in trading, in general, successful trading always involve a lot of emotion and psychology. Although it's not much mentioned, but I think that's very critical to the success of a trader. Okay, so conclusion is this: I think straight trading is very good for risk reduction, and it's very margin efficient because you only require such a small margin, to trade a particular spread contract. Unlike outright, you need a much bigger margin. So, however, you really need to be careful. Seasonal and fundamental factors, even sometimes could be a external news like a war. It can actually create chaos in the spread market as well. So not necessarily that means that or in the spread market everything is rosy. You don't see much opportunity. Sometimes you do, especially when markets are in a panic state. So always trade the plan, measure your risk exposure accordingly. So I use ATR as a way true range to measure the risk, and you work on the risk to reward ratio. So this time I say technical strategy can work. Heiken, Ashley, and using moving average, you pair these two quite well together, you can get quite a good entry setup. Now, again, this strategy spread because of what the nature of volatility is much lower. You don't always get a setup every day. So, in a sense that you just need to be patient enough to wait for the particular setup to appear. But once the market tends to trend, it does trend quite well. Now, straight trading, it does look difficult in the beginning if you're new, but over time, if you get the right coaching, you get, if you read more and you practice more, you get easier because once you understand the basic principles of it, it's actually very easy to master spread. So I'm just going to end with a few quotes. So I always mention this in all my webinars. I think the goal of a successful trader is always make the best trades. Money is always secondary. So manage your risk well. Eventually, your profit will come. So one bit also I want to highlight to the audience is that you must know how to learn to take losses. So whatever strategy I share with you today doesn't mean it's going to be 100% sure thing. No, this is very I would say no, it's difficult to achieve 100% because the reality of the market is very dynamic, variable. So your strategy may work in certain period, your strategy may not work in certain periods. So importantly is that you also must have the ability to take losses, and you do that well, and you can control your loss well. Generally, you can be a very profitable trader at the end of the day. Okay, so I'm just going to end here and hand it over to Su Ling for any questions from the audience.
Okay. Thank you, David. Okay. Thanks a lot, David, for the great sessions. Now, let's move on the Q&A sessions. So, ladies and gentlemen, if you have any questions, please feel free to ask. Yeah, just now when I look at the final slide, the conclusions, yeah, there is no 100% in the trading. It
Yeah,
really depends.
yeah. There is no 100. I mean, always people claim that, oh, I have a high hit rate, I have more than 80-90%, that kind of thing. But ultimately, if you can't manage your loss well, you have success, you have consecutive successes, but if you don't maintain that well, you don't have good risk management, your whatever you make can also lose back.
Yeah.
So importantly for a trader is that it's more about the risk and the management of loss. That's more important.
Yes. So while we are waiting for the question, I have a personal question to ask you.
Sure, sure.
Can you share with us what is your highest percentage of winning in a single trade since you started trading until now? Highest percentage.
Highest percentage of
Yeah.
winning trade.
Single trade.
Okay. I would say I just give percentage wise. I've seen based on I've seen per day I can make 50% of my equity. That's considered very good. I've not seen anything higher than that. So I'll consider that as one of my highest I've seen so far.
I see.
50%.
50.
Yeah.
Wow.
But this usually happens when market are very volatile. If market is very quiet, subdued, there's no trend, clear trend in the market. Because I'm a trend trader, so I look at trends in the market. So if the market is not trending, there's nothing much I can do. Yeah.
One more question. Also personal question. I think
Sure,
a lot of traders also would like to know. Like for example, in 1 week there's 5 trading days. So normally, if when your performance is good, right, in 5 days, how many days you will win, how many days you will lose?
Okay.
Most of the
I
time.
mean, just to share the background of my journey, when I first started trading, it was never easy. So I was not profitable for many months during my initial years of trading. I only started become profitable after year 1. It was never easy. So I don't have a clear record, but I would say, out of 5 trading days, now generally on average, I probably be losing only 1 day. And when I lose very minimum. So if I lose, I hit a certain threshold and I say, okay, I stop. Something's not right. Then I don't want to trade.
You just like
So I would say, generally, if I would say one out of 5 trading days could be a losing day, but the rest of it is generally quite profitable. But importantly, it's not that. It's more important that when I lose minimum. So it's not a big impact, not a big hole. If I lose a big amount, then I feel very painful.
still can handle. So far still can handle well.
Yeah. Been doing this 7 years, so people say how do we judge a successful trader? For me, is one of the ways is to look at how long the person is in the market. So you will know you got a statistics, right? You open, you got your retail, you got clients who open an account with you after 6 months or a year. How many of them are still trading in the market?
Yeah.
Not many, because that's the reality of the market.
Yes.
It's not it's not like everyone come in sure make money. No, it's not the case. It's far from the case. So if you can survive over a period of time, actually you're considered quite okay.
Yeah. Sure. Okay. Now we got about 2 questions from the floor. Okay. Yeah, there's one question related with inter commodity and intra commodity. So just now, based on your slide, you're giving the example Pusa product, within Pusa product like soy and palm.
Mm.
Did you try before that? And what is the outcome?
Actually,
Later?
I don't really try that. I tried during the beginning stage, but I felt that
Mm,
the dynamics that are affecting the spin oil not the same factor that affect palm oil. So sometimes the spread can go very wide for no reason.
mm,
So because of that nature, I cannot really comprehend
mm, mm,
much detail in how the
mm.
bean oil market works. I tend to avoid that particular intermarket spread. So I focus a lot on the calendar, the intra-market spread, the calendar spread itself.
Okay, all right. Now we move to the next questions. Okay, wow. Okay, in futures trading, leverage is one of the key characteristics. So would you agree that this is what attract many speculator or market participant, which allowed them to use a relatively small capital for the potential to make a bigger gains in the market? And then there's a continue. However, when it comes to spread trading, some outright traders often will comment that the return is not as exciting. So do you think this is reflect a conflict of objective in futures trading? For your
Okay,
personal opinion?
yeah, that's a very good question. So I think generally because the nature of futures contract itself is already leveraged, and therefore, you only put out a margin, a small deposit as a margin. So therefore, it's actually quite, risk approach lah. So yeah, in a way, it does attract a lot of speculators because of the leverage factor. And so I mean, in a way, leverage you must understand is double edged. You can win, you win a lot because you place more capital, but when you lose, it's an unlimited thing. You can lose more than your capital. So that's where one must understand leverage is a double-edged thing. So you need to be very careful when it comes to risk management because you're dealing with a leverage product. Now, going to the second part of the question, talking about spread, whether it's conflicting with our objective of going into a futures market space in the first place, it's not very conflicting. But I would say if you compare, futures outright and spread, clearly spread has lower volatility, lower risk. Now, because of the nature of lower volatility, you definitely cannot see much money. For example, let's say outright, the range is 50 points, but your spread is only 10 points or sometimes 7 points. How much can I see? So that's where it comes in. Sizing matters. So you can't be just doing one lot on the spread contract because the margin required is much lower. So you could be doing about 5 lots, or even up to 10 lots. So sizing again is another skill that's needed for a trader. So I would say this. I think is I wouldn't say it's conflicting objective. In fact, I think it's more of reducing a risk. Spread can definitely be a strategy to reduce risk. So if that's again the principle of why in the first place you go into futures trading, if you look at it, if you size up accordingly in the spread market, it can also be very risky. Although you can see, 7 points is not much, but you do 20 lots, 30 lots on 7 points, it's a lot of money. It can go against you a lot of points. So I would say spread involves a lot of sizing factors as well. And that's also another skill that you need when it comes to spread trading. So I would say I would answer this. It's not conflicting. In fact, spread trading can also be highly risky if you don't size up well. If you size up too much, you expose yourself too much risk. Sometimes it's even more risky than outright trading. It can happen.
Mm, right. So now I have a very specific questions about okay, if a trader only have 5K of capitals, so how do I manage my loss size to sustainable in the spread trading?
Okay, very good question. I would say this to answer that question very honestly is very tough. Because it's a small capital, but obviously it still can be done. So that means you probably max you can do is only 2 lots per trade. And you have to pick because once the market starts to trend, when spread markets tend to start to trend, try to hold your position longer. So as long as Haken actually is green, is both the moving average is going up, hold that position until you get like like let's say 10 or 15 points as your profit on two lots, it's still quite substantial. It's a small margin to begin with. Obviously, more margin is better, but it still can be done. So spread tends to trend. That's one thing. And when trend happens, stick with the trend for a longer period. So that doesn't mean you just based on what I told you, or look at one to two risk reward ratio. It could be even 1 to 4 or 1 to 5. Because you are using a smaller lot size with small capital, hopefully you can gain, you can ride the whole trend. That's one way of looking at it. So once you achieve your desired target and you can manage to increase your sizing, that's also another good opportunity to look at, because eventually your equity will grow as well once you size up accordingly.
How about if we're placing stop for the spread when we enter
Sorry?
after we enter markets, we're
Yeah,
placing a stop order for the spread.
yes, you can do that. You
Mm,
can do that. I highly encourage you to do that as well. But
mm,
I mean, if you are doing spread like a swing style way, try to ride the trend. So if the trend is in your favor, move your stop
mm,
to your profit level, or to your entry level. So you
mm,
move your stop accordingly.
mm,
So that's one way. In case you stop up, you're not losing all your money. You still
mm.
at least protected some of the profit. So yeah, you can actually play stop based on spread strategy as well.
Can try to doing like trailing stop. When the market move
Yeah,
in favor,
correct.
then you try to move the stop.
Yes.
Yes. Okay. All right. Okay. Further questions. What do you do when the fundamentals and technical signal is different?
Okay, that's a very good question.
Mm,
Despite I told you, I when I first started this business, I was analyzing market. I started as an analyst role. So I analyzed the market quite thoroughly. But having fundamentals is not to say it's an edge for you in spread trading. May not be. Sometimes it does happen. Fundamentals are telling you, hey, it should be a bullish market, but how come the spread keep coming down? How come the spread is telling you it's a bearish scenario? So always look at where the spread price is, what the spread price is telling you. Is it coming down? If it's coming down, I always follow on the technical side. Fundamentals, sometimes, it does, to me, it play less reliance. But obviously, like certain news, like, weather play, or government policies, that I'll pay a bit more attention. But seasonal factors, I say sometimes seasonal factors doesn't work. It could be this year that it doesn't work.
mm,
It could be this year, maybe
mm,
production peak in December. It can happen. So
mm.
that's where I tend to be a bit more careful. So for me, it always goes back to where the price of the spread is technically, and I will just trade based on that.
Okay. Right. I think next we open the last question. Okay.
Sure.
Okay. There's one trader who trading both outright and spread. Okay,
Mm.
and he is interested to hear from your personal experience. When
Mm.
do you find spread trading is more suitable than outright tradings? For example, would you prefer spreads in the more volatile markets or during quiet periods? And last one, the together one, would you trade both outright and spread in same time? Meaning that you're holding a spread and then you also go trade the outright. Do you do that?
Okay. Yeah. Okay. To answer the question, yes, I do trade sometimes. For me, it's simple. If I see opportunity, whether it's outright or spread, I'll just take the opportunity. My role as a trader, full-time trader, is to make money, regardless whatever strategy. As
Mm,
long as the market presents you opportunity to make money, you take it. Now, sometimes I also do both outright and simultaneously to handle spread. But keep in mind, the mechanism of your broker will work differently. If you're holding an outright position and you accidentally do a particular month, technically you're like closing the particular outright contract already. So it can get confusing, and it can
yeah.
complicate your ultimately your end day statement and whatnot. So
Yes.
I would say this, it's best to try to separate both. If
Mm,
you just look at spread, just look at spread.
mm,
If you're doing outright, then just to do outright, because the fear that if you thought you have an outright position, but because you already closed by a spread contract, you roll it to another month, then you get
mm,
confused. Then it depends on what price that you roll, based on the calendar spread. So it can get very confusing when it comes to looking at your end day statement and whatnot. So to avoid that complication, you tend to avoid doing both simultaneously. But when opportunity arises, when you start to see outright trend more, yeah, I sometimes I do write on both markets.
mm.
So yeah. What's the first part of the question? I
Oh, the
didn't get
first
the
part.
first part.
Uh, sorry. The first part, okay. When do you find the spread trading is more suitable than outright trading?
Okay. Okay. So, for me is when, let's say when markets are very quiet. So outright there's no particular trend. Sometimes you can see outright no trend, but actually spread is trend.
Mm.
So that therefore I will actually focus more on spread.
Mm.
But if sometimes the outright doesn't show trend, spread also doesn't show much trend. So normally if that's the case, then you can use range trading strategy whereby you establish the high and the low, you just play along with that. So that's one way I look at it. But for me, I think when when spread tends to trend, especially when usually outright will tend to trend, then I will actually look into the spread market and find opportunity in that regard. So when spread tends to trend, that usually be a good time for me to look at the market.
Can I open one more question, sir? Okay, we still got some
Sure,
time.
sure,
Okay, one more question, sir. Notice
sure.
that
Great.
sometime further months has low volume if trader want to cut loss. For example, now it's 2025. Sometimes we notice some trader they trade further like 2026 contract. Okay, so it is tough as the volume is no there. What should the trader do? Should trader open the leg, like
Good.
yeah, like make it become a outright?
Yeah. No, if you open the leg, if you break this particular candle spread to
Mm.
become outright, there's risk. So usually when you trade 2026 contract, the volume is not there.
Mm.
So sometimes your bid and ask spread can be very wide. Sometimes because there's no people quoting or the quotes are quite fast. So if you want to break the leg, you are technically paying a higher cost. That's one thing. So second thing, but if you already established a farm contract, I think one way is either like if you find it that it's the bid and ask, you can take it for the farmer contract. Try to break the calendar spread if you can. If not, since this expiry, as we get closer, the volume will generally be able to arrive. So if you can wait, you wait it along. But if you can't, generally you just come up on a particular spread. Generally, sometimes you get better price in the spread market compared to breaking it outright or breaking the calendar spread links. So that's one way I'll approach it. But normally I won't get myself entangled with too far because, like I said earlier in the beginning, when you start to trade 5-month contracts, normally you don't see much volume, and this is a danger.
Oh. So now currently we are trading on the active month like December. So the farthest month you would choose is around until
Okay, I won't go anything above April.
April.
So April 2026, May 2026, June
Mm.
2026. I'll
Won't touch.
probably my rule is 6 months. So
6 months.
December, January, February, March, April.
Mm-mm.
So anything after April, like May, June, July next year, I won't touch.
Okay.
6 months at least you can see that visibility. After
Mm-mm.
6 months, anything can happen.
Right. Okay. So I think that's all for our Q&A sessions. And thank you for the great
Okay,
questions from the floor. So before we close, okay, David, I need to share my screen
sure. Go
for a
ahead.
while. Okay. Okay. So just a quick note for everyone. We have set up a Discord channel where you can connect with other traders and you can also learn more through the MyBusa website. Okay, so next slide here is the channels. Join us and join the discussions with the traders. Okay. Okay. Next. Okay, plus we have another webinar sessions on this Thursday, 9th of October. Same timing, 8 to 9:30 on the risk management, psychology, and journaling in FCPO. Okay. Not only that, next up we have cryptocurrency futures webinar. As Apex just recently offering the micro Bitcoin and Ether futures, we are excited to bring you another special sessions. So just mark your calendar and join our learning sessions. Sorry. Okay, so here is the excited part. Let's take a look on the leaderboards of our trading challenge 2.0, which kicked off on the 1st October, which is on the last Wednesday. Yeah, a big shout to all participants. You are doing the great and keep pushing forwards. So for those who haven't joined yet, the registrations still open until the 16th of November. Okay, so our registration is start from 15 Sep until 16 November. Okay, so don't miss your chance to be the part of trading challenge. Of course, at last, a big thank you to our speaker, Mr. David Ng, for sharing his insights tonight. Thank you,
Thank
David.
you.
Yeah, and thank you all the participants for joining us tonight. So this is our dealing support hour. So if you need the information, just screenshot. Okay, so see you in the next sessions and happy trading and good night to everyone. Thank
Good
you.
night. Thank you.
Yeah, thanks.